The S&P 500 and all other indexes have done pretty badly this month as the September curse seems to be taking full effect. This curse also seems to be bleeding into October as today my portfolio did abysmally. Because of this, I have lost around $1,300 since my last update video in unrealized losses, which is surprisingly an outperformance of all three big indexes, if you can call it that. The reason I was able to do okay this month when compared to these big indexes is because some of my positions from last video, Coca-Cola, Starbucks, Union Pacific, and American Express for example, have done extremely poorly, but I don't own any of these anymore. Since my last video, I sold out of many positions and did so at a pretty good time while deciding to mix up my portfolio. The changes I made drastically decreased my dividend income, which is definitely a bummer, but I think over the long term, the growth will be well worth it. Despite this, every stock in my portfolio still pays a dividend, which I think is key and is very motivating to see those checks come in. So in this video, I'm going to be discussing these new positions of mine and what my plans are for the future and why I decided to sell out of some of my biggest positions. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. So I sold out of 5 positions entirely since my last video: American Express, Union Pacific, Coca-Cola, Starbucks, and Ares Capital. Surprisingly though, all of these stocks have done pretty poorly since my last video, so I actually sold at a decent time. Coca-Cola, which used to be my largest holding, has done terribly since I sold it, so I'm feeling pretty good about these sells. The reason I sold out of these companies was because for my time frame, I thought that they didn't make that much sense as I am a young investor and I thought there were better options out there for me specifically, and I'll get to that later in this video. Now, one company that doesn't really fit this description of why I sold it was Ares Capital, and the reason I sold it is because it seemed to be at a high stock price when I did, and I'm looking to potentially rebuy shares when it goes lower as the stock follows a semi-cyclical pattern. Anyways, let's get into my new buys and I'll talk more in depth about why I sold some of the companies I did. Okay, so now we're actually looking at my portfolio, and the first thing you're probably going to notice is that I'm at $26,900 currently, which is not $1,300 down from my last portfolio update. It's around only $600. Now, the reason I'm only down around $600 from last video, even though I said I was down around $1,300, is because I put around $550, give or take, into this account for new purchases, and I also gained around $234 today in the market, and the script I recorded for earlier in this video was recorded yesterday, so yeah, I mean, that was a bit of an error, but the point still stands that this month has been pretty abysmal for the stock market. Anyways, though, let's get into my positions, and we're going to start from the top, which is my biggest, and go to the bottom, which is my smallest, which is what we do every time on this channel. So my new biggest position is now the Vanguard Index, aka VTI, and it used to be Coca-Cola. I currently have around $5,200 of this ETF, and it makes up around 20% of my account as I have around 24.5 shares. It currently trades at $210.56, and my cost base is a bit higher than that at $216.37. Now, the reason I subbed out Coca-Cola for Vanguard is very simple. It's super well diversified. I want my biggest position in my portfolio to be something I didn't have to worry about, and I thought that was going to be Coca-Cola, but honestly I was worrying about it more than some of my other stocks, which didn't really make sense for what I wanted it to be. I want my biggest position to be a bedrock position, and there literally cannot be a better option than VTI. This is Vanguard's broad market fund, and it has around 2,000 holdings, but it largely tracks the biggest companies, meaning it's a very good ETF for some of the large cap American holdings. It pays a dividend of around 1.5%, which is market average and is basically okay, so I'm pretty happy with that, and even though it's going to be a little bit on the lower end for a dividend portfolio, it's not anything to complain about. Now moving on to my next biggest position, I have the Microsoft company, ticker MSFT. I currently have around $4,300 of this stock, and it makes up around 16% of my account with 13.5 shares. Now, as you can see, my total gain/loss on this is around 2% as I bought at $324 and it sits at around $319. However, I'm not too worried about this company. This is going to be a long-term holding, and it also has super good growth potential. Microsoft's new AI in their products definitely makes their products more appealing to consumers, and hopefully they will be able to get more market share in some of the markets that they aren't really that great in, such as search engine. If their AI renovation technique goes to plan, then this should be a no-brainer stock for the future and should be probably the best tech stock that you can buy. Although I'd love to dollar cost average this down, if the stock is to continue to appreciate, it already makes up around 16% of my account, which I think is a little bit large. The truth is, going to the future, I want to keep buying more shares of VTI and make this a larger percent of my account as it's something I don't have to worry about and have individual stocks be my backup. However, Microsoft is definitely a premium company with a super good underlying business, so I'm not super worried about this. Maybe a little bit in the short term, depending on market conditions, but in the long term, I don't have any worries about this stock. Now, my next biggest company in this list is Apple, ticker AAPL, and this is one of the positions from last video that I have not changed. I'm currently up around 6% on this stock, which is pretty good, with an average cost basis of $163.86. This stock has seen some pretty massive decreases within the last few months, and it mainly stems from two things: a semi disappointing iPhone 15 launch and scares about its sales in China. Now, the truth is, there were definitely some scares about iPhones being banned in China, but I don't think this is very likely to happen. If China was to ban the iPhone, it wouldn't just negatively impact the company and the US, it would also negatively impact China themselves. China, like the US, benefits from having Apple do business there, so removing the company completely out of the country wouldn't really make sense, so I'm not too worried about that. However, their iPhone 15 wasn't super worrying for me, but it definitely was a bit eye-opening. Apple has seemed to have lost its magic that it had before with the new iPhone releases. It used to be that the new iPhone releases were a big staple in everyone's year, but honestly, they've become a little bit more lackluster as the years have come on. Despite this though, I'm not really worried about Apple as a business because I'm not looking at their hardware as much as I'm looking at their software going into their future. Apple has a great business model and a super reliable ecosystem that customers love, and Apple basically has a money printer based off this machine. Apple makes a ton of their money off stuff like the App Store and Apple Music, and a lot of that they don't even do themselves, they just take a portion off app developers and musicians. For example, if you are going to buy an app on the App Store, Apple takes 30%. The thing is though, is Apple didn't make this app, but they're still taking a cut of the profits. This is allowed because it isn't really a monopoly, because there still is Google Play to rival, but the truth is that all app developers need to publish on iPhone in order to get their app out there, so Apple has a great way just to make money for what is free. Looking into the future, I'm going to start perceiving Apple as less of a hardware company and more as a software company, even though I think hardware will still make up a majority of their power. Now, the next stock on my list is Visa, ticker V, and they are the stock I'm currently the most down on at almost around 5%, even despite a 1% gain on the day. My average cost basis is $242, and the stock currently sits just north of $230. Visa is another stock similar to Microsoft that I clearly overpaid a little bit for, but I'm not too worried about that. Visa is a cash printer. They have a net profit margin of around 50%, and they do a similar thing to Apple with the App Store, is that they take money from people that are buying using their credit cards, but they don't really have to do a lot to get that money. There are no products that Visa has to create to sell, which is why their profit margin is simply so huge. Also, since inception, Visa's dividend has increased by 1600%, showing the dividend growth is definitely there, and to buy now could potentially get me a good yield on cost in the future. Overall, Visa is a premium business and is going to demand a premium price tag, but it's clear I still overpaid a little bit. This is one of the stocks that I sold American Express for, because going into the future, I think Visa will just be better. That being said, I'm aware American Express and Visa aren't as similar of companies as they may seem on paper, as American Express is definitely a bit more on the mature side, but I think in the long term, Visa will pay off dividends, both literally and figuratively. Now, the next stock on this list is another stock that remains from my last video, and it's Broadcom, ticker AVGO, but as you can tell, I actually sold one share since last video. I'm still up around 33% on this stock, and it is by far my best performing stock that I currently own. Broadcom is one of my favorite stocks, obviously because it's performed so well, but it also pays a very good dividend, and it's still over 2%, which is still beating market average despite being such a good growth stock. The reason I sold a share is because I just wanted to trim the position, as it was getting a bit bigger than what I wanted it to be in my portfolio, similar to where Microsoft is now, but I'm more okay with Microsoft being that big than I was with Broadcom. That being said, Broadcom is a fantastic company, and I think it is very important that all people who are currently going for a growth portfolio mindset has at least one chip manufacturer stock, as this will be key going into the future as the world becomes ever more technologically advanced. Broadcom also has some very simple secured earnings going into the future, as they have some major deals with companies such as Apple. The next stock on this list is JP Morgan Chase & Co., which I have around 22 shares of at an average cost basis of $144.29, and I'm down around 0.5% on this. Now, the reason I bought JP Morgan Morgan Chase was, again, similar to Visa. It was one of the financial stocks that I got in replacement of American Express, and that's simply because JP Morgan Chase is probably the best bank you can buy into right now. This mainly stems from their super strong leadership under CEO Jamie Dimon, and it's clear because he has been there since before the financial crisis, which is unheard of for CEOs in the financial world. JP Morgan's fortress balance sheet strategy makes them one of the safest bank stocks you can currently buy. Although their yield when compared to other comparable banks such as Bank of America is a bit on the lower end, I'm not too worried about that as I think overall their business will outperform. Overall, I think JP Morgan is one of the best financial stocks you can buy, and they're going to be paying a dividend pretty soon, which I'm definitely looking forward to. It's going to be a bit over $22. Now, the next stock in this list is United Health Group, ticker UNH, and this is another stock that I haven't changed since my last portfolio video, except I have bought a little bit more shares. Simply put it, healthcare in America is stupidly expensive, and you're going to have to buy that from somewhere, and United Health Group is the biggest health insurance provider. They are a stock that grows tremendously, and they also offer a pretty sizable dividend, which is a little bit better than market average. What's more impressive than their dividend yield, though, is their dividend growth. UNH currently offers a 5-year dividend CAGR of 15%, which is super strong. In addition, their growth prospects are not looking bad as their market share of the US continues to expand. Overall, I only own one healthcare related stock in my portfolio, and if you are going to do the same, I recommend making it UNH as it's probably the best that you can buy. The only other two healthcare stocks I'd look into buying would be AbbVie and Johnson & Johnson, but I do prefer UNH to both of those. And the last stock on this list is a new one, and it is Main Street Capital Corp, ticker MAIN. This stock is a BDC, and I made a video about this stock not that long ago, so I'll put a link to it in the description below. It was one of the stocks that I talked about in my high yield stocks that you can hold forever. I own 24.5 shares of this company at around $40 as my average cost basis, and it currently sits at just under $40, meaning I'm down around 0.3%. However, it is very clear the reason I bought this. I bought this stock because of its great dividend and the fact that it pays monthly and it pays around 7%. This is a way just to boost my income and make sure it doesn't fall too much and make sure I'm not only chasing growth with this portfolio. Although my time frame makes it so a more aggressive portfolio would perform better, I still want to have some more reliable dividends here so I can keep increasing my income because eventually I might need to use that for something other than just dividend reinvestment. Now, the reason I subbed out ARCC for Main is for two reasons. First of all, Main pays monthly, which I think is a very big upside, and also ARCC follows a pretty cyclical pattern of stock price, and it was nearing the higher end of that pattern, so I decided to sell, and I might rebuy shares in the future. However, if I am to rebuy ARCC shares, I will buy it in addition to Main Street Capital Corp instead of just one or the other, because I think having both of these companies paying me dividends would be super beneficial for my portfolio. Anyways, guys, let's look at the dividend view really quickly. As you can see, my total dividends annually now is around $450, which is a sharp decrease from last update. However, I think overall this will perform better in my portfolio as not only will these dividends grow more over time, but the stock price should as well. I'm currently sorting by yield, but if I'm going to sort by estimated annual income, as you can see, JP Morgan is my biggest pair, which is around $93, and my second biggest is VTI at around $82, but that's because it's 20% of my account. And Main Street Capital Corp, even though it's only 3% of my account, is already almost at $70, and this pays monthly, so this will be compounding quicker than these other stocks. Overall, I think my current dividend income is much healthier for my time frame, and it makes a whole lot more sense. In my last video, I think my portfolio paid a little bit too much, and it simply didn't make sense for my time frame as I needed something a little bit more aggressive. Anyways, thank you guys for watching this video. If you liked it, let me know in the comments, and if you don't like my new picks, let me know why as well. I'm super interested to hear what you guys have to think. Anyway, guys, thank you for watching. See you in the next video. Goodbye.